volatility smooths itself out over a long enough time horizon. So you just have to be comfortable with those sorts of movements.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Austin, thank you so much for joining me today. Super excited to chat with you. All right, Austin, you are the founder and managing partner of Relayer Capital. Relayer is a thesis-driven crypto asset investment fund with both liquid and venture strategies. Previously, you worked in finance, fintech, and crypto. From being a founder at Promeritum, which I hopefully I said that correctly.
No, you did. That's right.
Nice. Promeritum Labs, to being a partner at CoinFund. All right, so Austin, going through your LinkedIn, you actually started in 2013 at a company called Payoneer. That was like a fintech company. Is that where you discovered crypto?
Yeah, I discovered crypto a little bit before that. I graduated from college in 2013 and first came across crypto that April. So I got a call from my brother, and he said that he was invited to a poker game where the buy-in was with Bitcoin. The buy-in was 1 Bitcoin. So at that time it was $40. And he ended up winning the game and wanted to figure out, like, how do we receive this, custody it, everything. So worked with him on that. And that was my first introduction to Bitcoin and crypto. Ended up joining Payoneer, which is a cross-border payments company. So, payments obviously is very, very related to crypto and kind of the initial core vision of peer-to-peer money. But yeah, it was actually ahead of Payoneer by a couple months through that, very serendipitous phone call and poker game.
That's so cool. Did you, when you first were exposed to this idea of Bitcoin and digital money, were you like, did it click with you right away, or were you blown away, or was it more like, oh, this is interesting? Like not a huge deal though.
I found it very interesting, but I don't think it really clicked in terms of the scale of what it could become. And what the moment for me was early 2016, when I came across Ethereum. And I think that was the difference for a lot of people, where the idea of, sovereign, non-sovereign, censorship-resistant money is one thing, but the idea of having programmable money in that same context was much more interesting and kind of what captivated me. And the idea that you could build applications on top of it. And programmable money is a lot closer to payments and fulfilling that vision of really seamless, global, cheap, low cost, and high speed payments. So that's what really pulled me into crypto. And when I started going down the rabbit hole, so I got a taste in 2016, and then 2017 was 2017. So that was a crazy year.
So at Payoneer, did you like talk about crypto at all, or was there any sort of crypto connection there, or were you pushing for it, or it was just like still way too early?
Yeah, so it was still very early. I was definitely pushing for it internally, and was going to a bunch of conferences. A lot of it was to see what sort of strategy could I incubate internally, and how could we learn as a firm. But it really wasn't a fit at that time. I think I was the extreme outlier that was really into crypto and kind of falling down that path. And when I ended up leaving in 2018 to start my startup Promeritum Labs, I got some quizzical looks in terms of the making that decision. But also, I don't think anyone was surprised based on how much I was talking about crypto for the preceding year and a half. I think it was very obvious that was where my passion was. But over time, more and more people have gotten red pilled. So my boss at Payoneer, who was the CFO there, is actually now the CFO at Fireblocks. So everyone ends up making their way to crypto.
That's crazy. Very cool. All right, so 2018, you're like, I have to do something in this space. Promeritum.
Yeah.
Promeritum. From what I gathered from your LinkedIn, it was like building financial products for crypto assets. So it's like, it sounds like it was a bit, you were trying to connect the TradFi world with DeFi, which I think is I mean, or like DeFi wasn't even a thing back then. So like tell me what were you trying to like conjure up with this?
So I think the easiest way to think about it is it was a very early iteration of a borrow lend, but with a slightly different purpose, because the idea of DeFi really is making financial products accessible to anyone, having this open permissionless environment, having free flowing rates and capital. And a lot of the vision with what I had was, and my co-founders there, was the same. The difference was the target audience, where if you remember in 2016, 2017, there was that thesis that the institutions are coming, right? So you're going to see banks and like large asset managers and allocators begin to acquire Bitcoin, Ethereum, and other crypto assets, which has ended up happening. But I guess 8 years later, now is the institutions have come moment. But at that time, what we realized is, all right, like, so if you have these larger more sophisticated capital allocators that are beginning to acquire crypto, they're going to want to make it more capital efficient. They're going to want to borrow against these assets. They're going to want to, build in leverage, but also, they might have potentially capital requirements, especially if you look at like actual banks and what they need. So we were looking to build products to service that need, and looking at things like overnight repos, which we're starting to see a little bit and seeing some experimentation there. But yeah, that was what I was building in 2018, 2019. And we found some early adoption among some of the like early liquid funds, but not really a ton, because this wasn't a meaningful demand. And it was also pretty well serviced on the centralized side. So like have a decentralized protocol for this wasn't as critical. And then, of course, the missing piece in 2020 that we saw originally with Synthetix, but then, with Compound and Yearn and others, what was the yield farming and the tokenization piece that really accelerated and created DeFi Summer. But yeah, that was the idea. So kind of a institutionally focused borrow lend.
That's so cool. It's you like DeFi before DeFi, essentially. Like that's
yeah, and it was something that I was really excited about, because when I was trading at that time in 2016, 2017, I was trading on all the like centralized exchanges at that time, but also there were a couple dexes that started to pop up. That I can try to remember the name of it had an I. I'm blanking on the name right now, but it was actually an order book based DEX, but on Ethereum mainnet. And the problem there was the block times were too slow. So like, we're thinking about how do you implement order books on an L2 today, and what are the advantages of like Arbitrum or Base or Solana versus like what Hyperliquid is able to do, and having like application specific ordering. But yeah, imagine like having an order book, not an AMM on Ethereum, and trying to execute there. But was doing a lot of experimentation on chain in the early days, so it was fun.
That's amazing. Okay, so after that, you went to 21 Shares, which correct me if I'm wrong. 21 Shares is kind of the crypto ETF type of company, like products like that. Is that roughly correct?
Yeah, that's correct. So they're one of the large ETF issuers. They have a Bitcoin ETF, an Ethereum ETF. They have about 7 billion, or probably even more now, approaching $10 billion in assets in their products. When I was there, that was before, of course, ETFs were approved and went live in early 2024, or at least ETFs in the United States. So at that time, they were focused on exchange traded products, so ETPs based out of Europe. So on the Swiss SIX exchange, Nordic Nasdaq, Deutsche Börse, and other European exchanges, and had products for Ethereum, Bitcoin, an index, BNB, Solana, Tezos, a whole bunch of different assets, and bringing those products to market, primarily focused on like smaller institutions and high net worth individuals. And the difference there is, in the US, you have the Grayscale products, so GBTC and, the Ethereum Grayscale product. But there, because there weren't instant redemptions and creations, you had this whole thing, which became, like a hedge fund trade of its own, and ended up blowing up a couple of different businesses, where GBTC would trade at a premium, and then, people would try to issue it and then sell it 6 months later when it became available to be sold. And then it ended up trading at a discount, where as the ETPs from 21 shares and, what a standard ETF is versus a trust product, which was the Grayscale product, they always trade 1-to-1 at exactly the net asset value. Where it's interesting, we're kind of rerunning the whole GBTC playbook with DATs, where now you have things trading above the value of the assets that they hold. But, that's a whole other conversation.
But I mean, debts are going to end very well. I mean, there's no way they can end poorly, correct?
I think it's impossible, right? It's impossible that they don't end well. No, I think it's stats are interesting because they're all started upon the principle that you can acquire additional assets in an accretive way because it's trading above NAV, and if it's trading above NAV, you can sell stock to buy more assets. But if you take away that first principle that they're trading above NAV, and they inherently will, then the math becomes a lot more difficult to calculate.
I want to dig a lot deeper into that later. But okay, so after 21, you went to CoinFund. You were actually a partner at CoinFund for I think 3 years, and you were doing both venture and liquid. So tell me about that experience. CoinFund is a stellar firm. So tell me about.
Yeah, it was a really great experience. I actually got connected initially with Seth, who runs the liquid fund. We were in a mutual Telegram group back when I was at 21 shares, and they were looking for some folks to join the team. At that time, it was only 6 people, so it was pretty small. It was a couple years in since Jake started the fund in 2015. But the liquid fund hedge fund had only started a couple years earlier, a couple months earlier rather, and they were investing out of the second venture fund. And yeah, we really just hit it off, aligned on vision and thesis, and where the markets were heading. Joined in September of 2020, so during COVID. Didn't meet any of the partners in person, but before joining, I think actually met with them for the first time obviously over video we chatted. I think met with them the first time in person though maybe February, so a couple months later. And yeah, really got to work on the venture and liquid side. It was an interesting time because we were right past DeFi summer, but things were still accelerating there, but also right before the NFT boom. And I remember talking with Jake in August when I was first connecting with the partners there about Rarible, and because CoinFund had just done their pre-seed round, and NBA Top Shot, because CoinFund was an investor in Flow. So it's really just wild to think back to those times.
It's very cool. All right, so at what stage did you decide, okay, this has all been amazing, CoinFund's a great firm, but I want to go do my own thing? Relayer, what was the idea and thesis behind Relayer Capital?
Yeah, so I guess taking a step back, I'd always known that I really wanted to launch my own firm. I kind of had an interesting childhood. I started investing when I was 10 years old. So I started trading stocks when I was 10. I would, get the Wall Street Journal delivered in physical copy and read it in the morning, go through 10Ks and Qs. Did a lot of early tech investing then, because that was right past the tech bubble in early 2001. Bought Amazon originally at $7. Bought Cisco and Microsoft back then. What else? Was very early to a bunch of biotech names, alternative energy, streaming products, and others. So I was really fascinated by just markets and the idea that you could lean into these very, very interesting, somewhat early stage growth businesses, get to understand them, and potentially understand them with a different view than the rest of the market, and be able to unearth alpha and be a part of that journey. Started investing in options when I was 16. So it's just like absolutely fascinated by financial markets. Went to Wharton undergrad because I knew I wanted to follow this path, and then did some banking and trading internships, but were a little bit less interesting than I anticipated. Then again, like an entry-level internship is, I imagine, never that interesting. But my roommate in college was in tech and really into startups. So that's kind of what pushed me in the direction of joining Payoneer instead of going like a traditional finance route. But when I ended up eventually joining a fund, taking the more circuitous route through tech first, I knew that I always wanted to launch my own thing, and after about 3.5 years in, had made a number of investments that had done really really well. So a seed investor in Moonbeam, which at one point was a 300x and a $15 billion protocol. Early investor in seed round of Superstate on the asset tokenization side, which has been doing incredibly well. Seed investor in WorldCoin and some others. And then, on the liquid side, very, very early to Solana, and, one of the, I guess, biggest champions internally, and, pounding the table when Solana dropped down to, $8-9 in the end of 2022. So, by the end of 2023, when that time got around, it just felt like the right opportunity to build my own thing. And, especially with ETFs coming, it felt like we were about to embark on this next bull cycle. And if you're going to start a fund, you definitely want to start it in the beginning of a bull cycle, not at the top.
All right. So your passion for markets and finance, like, are your parents in finance or something? Like, how did that happen?
Yeah. So my mom was an attorney at the SEC, and then had been involved in financial markets probably. My dad is a corporate lawyer, but had been a futures trader. But it all really started because of a study or an article that my mom had read that in Hong Kong, children were learning about financial markets just as part of the curriculum in school, starting at age 10. So she was like, all right, well, this is interesting. They should learn a little bit about it as well. And I had so I moved around a lot growing up, and that I think ties into a little bit where I lived in Chile for 2 years, from age 9 to 11, and in Budapest, Hungary, from ages 12 to 14. So, and was going back and forth a lot. So during some of those periods of time when I was like in between school, I had an opportunity to just research and like dig in and study all day long. And then when I was living in Budapest with the 6-hour time difference, I'd get home from school at 3:30, 4 p.m., which is 9:30 a.m., 10 a.m. in New York time. So literally the markets were opening, and I had the whole evening where I could just track what was going on. And I've always just been really into math. Kind of numbers are what click for me. Like, it's a weird thing where I'll forget a name or I'll forget a face, but I'll like remember a random number that I heard once in some stat. It actually had an interesting carryover to history as well, because you can remember years and dates, at least in the pre-ChatGPT era. It meant that it was easy to score good, get high scores on tests.
Very cool. Very cool. All right. So your thesis with Relayer, like, if you have a blank slate of how can I design this firm to be exactly how I want it to be, what was your, like, with such a blank slate, like, how did you decide to structure it? Because obviously you had a background in venture, you had a background in liquid. So you're like, hey, we'll just do a venture fund and a liquid fund, or hey, we're going to combine one fund into being able to do both these asset types, or kind of, how did you decide to structure Relayer as it is?
So a couple things, I guess. One, obviously learned a ton from my time at CoinFund, and CoinFund's second fund was similar to this, where it was a liquid fund and it made early stage investments, but it was a closed-ended fund. The later liquid fund at CoinFund was primarily liquid, but did a little bit of venture. But I sat across all of these different vehicles, myself and Evan, who joined at that time, and had an opportunity to invest across all of them. And what I realized, of course, is there's ton of synergies to investing in both, in terms of the perspective that you get on markets. Because when you're investing in venture, you have a very, very clear signal in terms of what's coming next, right? Because you see all these early stage projects that are building. And that was one of the things, for example, that gave me so much confidence that Solana wasn't going anywhere, and the community was really strong. And there were a lot of really top founders and products being built, because I had insight into that venture pipeline. And then on the liquid side, you get a really strong sense for what is working, what isn't working, what sort of tokenomics make sense, what sort of go-to-market strategies work well. So you kind of have a much broader 10,000-foot view, but also you have perspective on seeing these interesting parallels that can help inform how you should think about and how you should pattern match what will or may work and what may not. Um, and then also one of the unique quirks about crypto versus traditional venture or liquid is there's a lot of stage crossover, right? So you could have something that's pretty much just launched and or they just started building their product and a token is live. So if you do no liquid investing and only venture investing, you may have one shot to invest or maybe not at all. Maybe they just go straight with their token. Or maybe it's something like Polymarket, for example, which has been around for a really long time but hasn't released their token. So if you're just doing liquid or just doing privates, you kind of miss half the market because of that stage crossover. And when you look at the structure of a lot of the early funds, Coin Fund being one of them, Multicoin's first fund, Parify, Polychain, others, they had this hybrid structure because there were a lot of benefits to it. So that's what I ended up going with, where it's set up as a hedge fund in terms of its ability to continually raise capital. So it's not just closed-end fund. You raise capital and deploy that capital over a period of years and then raise another fund. But you have complete flexibility over the sorts of assets that you invest in. But then taking that sort of venture approach to both liquid and venture, where you're saying, I'm investing over a long time horizon. I'm investing with a thesis, with a long-term view, focused on fundamentals. So you kind of get the best of a lot of different worlds.
So that makes total sense to me, but also I'm also a crypto guy. I've been in crypto for a while, so I get it. But with certain LPs, they might say, yes, I agree with you, Austin, that, we're also long-term, but maybe the market takes a, downturn and they freak out. And after a quarter, they're like, hey, get me out. What is the redemption schedule for, or what is the liquidity of these LPs? Can they just get out whenever they want? Or is it more so like, hey, you're locked up for 5 years or 2 years or whatever?
Yeah, so it depends on the fund, and depends, what you want to offer. Some funds will do as much as 3-year initial lockup, and then you can redeem on a quarterly basis. Some will do 1 year. Some have no lockup. What I ended up implementing was a 1-year lockup from initial inception, so you can get past that early period of volatility. And then what I ended up doing over time is just creating a share class that didn't even have a lockup, because I think the most important part was making sure before the relevant investor invests that you're aligned and they have clear expectations of the level of volatility that a vehicle like this will have and what they're looking for. And what I tell them is, this is long-term investing, but rather than a venture fund where, the marks don't change very regularly because these are private investments. This is mark to mark on a monthly basis that you'll see swings in both directions. And, I've been fortunate that my investors are, partners at other crypto funds. They're founders themselves. They're people that have been around crypto for a long time. So they really understand that. And, I've been very fortunate that all of my investors, have been extremely, extremely long-term aligned. So, I know for some folks, it's a lot of hand-holding their LPs. But for me, my LPs have been, the most supportive people that I can imagine. They've, introduced me to other investors. We have regular conversations, just debating and brainstorming around markets because, these are generally pretty crypto knowledgeable people themselves. And also, for the folks that run their own funds, people that have been doing this longer than I have. So they have a lot of knowledge to impart.
It's very cool. Yeah. I think finding that investor base that aligns with the what you're trying to build is so important. And it's funny because in the TradFi world, drawdowns and kind of volatility is like the enemy, but it's weird because if you come from crypto, it's like that's just the norm, and you can't have this volatility without without these types of gains. So it's kind of like, you got to find your people. It sounds like you did, which is very, very cool.
I think you interviewed him a couple weeks ago, Ray, from L1D, but he tweeted something the other day about one of the reasons why Peter Thiel has been so successful is because he's been very comfortable running a very high conviction, but also higher volatility book where the vol profile of his portfolio is 50 or 60, which is much, much higher than you'll see in traditional assets. But it's the old adage that it's hard to have one without the other, but volatility smooths itself out over a long enough time horizon. So you just have to be comfortable with those sorts of movements.
Yeah, it's funny because if you're truly long term, like truly, which I think few crypto people have to be, because we're like, man, this is how we grew up, like we have to be long term. But if you truly are, then the volatility shouldn't make you panic. But I think that for a lot of first time LPs into crypto, I think they're like, oh my gosh, like I didn't actually believe that, or hearing it's Bitcoin or ETH or whatever's down 30% in a day is like, yeah, sure, I read about it, but actually experiencing it is very different. So anywho, yeah, no, I think it.
And I think this is like the direction that crypto funds are moving more broadly. When I started the fund, ETFs were just launching, right? So you had a Bitcoin ETF, and then a couple of months later, an Ethereum ETF. So what I told prospective investors, and what the strategy is I'm not looking to charge investment manager fees on buying something that you can easily buy literally as an ETF right now and to pay 25 basis points in fees. That's not something that that needs to have a traditional 2 and 20 charged on it. So what I said is, you should own your own Bitcoin, you should own your own Ethereum, and then I'm taking care of and focused on early stage liquid and small cap liquid and venture stage. But I think that also helps because you never want an investor, or at least my perspective is that an investor should never be too allocated to one manager. But if they have their crypto exposure spread out between what they have on their own, that's long-term holdings, and what's with maybe a couple of different managers, then it becomes a lot easier, I think, for them to manage the volatility as well.
Totally. All right. So when you are going about looking for investments, are you starting from the framework of, all right, I'm going to go talk to all these new exciting teams that are building new projects in the space? Maybe the pre-seed, maybe it's like really idea and like a couple of folks and like an idea and a pitch deck, or hey, here's a simple working product, like these early stages. Or are you going first to the kind of the public markets and looking at, okay, what tokens are available now that might not have any or much less risk because there's a live product, people are using it, and I can see that they're generating revenue or whatever, right? I guess when you're first deploying capital, what are you looking at? You're going to the very early stage venture, or more so the public market liquid?
So I'm doing both simultaneously. So the target allocation for the fund is about 75% into liquid assets and 25% into venture. The way it works though is, an investor comes in on, day whatever, right? And all of the funds are invested in liquid. And then over time, that liquid is used to invest in a venture project as opportunities arise. So I think about investing across that entire stage. So, for example, something like Maple Finance is something that the fund has a strong thesis on, and right now they're generating about $20 million of ARR. They're about a $500 million FDV, and they have very clear product market fit that's accelerating. Or something like for example, Aerodrome, $200 million of ARR, couple $1 billion market cap. Really the economic engine of Base, or something like even a step higher, thinking about something like, Solana, right? Or Hyperliquid, right? You can think about like those levels of maturity. But then on the other side, most of what I focus on in venture is that pre-seed or seed, because there's the biggest amount of asymmetry comes from the opportunity to kind of understand a product vision and understand the thesis and be really early to that. So that's what I look for on the venture side, getting in at those very, very first rounds. round that Relayer invested in that was just announced last Friday was in Hyperbeat, which is kind of the yield layer for Hyperliquid. They have already over $300 million of TVL, which is it's interesting. It is their seed round, but they're a lot further along than you see for most other seed stage companies. Invested in, as another example, invested in Pipe Network, the CDN protocol, and invested in some rounds because Relayer is still a medium-sized fund, have the flexibility on check size where often we'll be the very first investor, where it'll be Relayer and then a bunch of angels in a pre-seed fund, or sorry, a pre-seed round.
Very cool. Okay, so on the venture side of the portfolio and the process, are you coming up with ideas of what you wish existed within, let's say, the crypto ecosystem? And I guess for this example, we'll focus on DeFi. A lot of the examples you've been talking about are DeFi related. So are you saying, okay, hey, there should be this DeFi protocol. It doesn't yet exist. Okay, I'm going to go try to find a team that's building that. Or are you just out and about? You're talking to people. You're like truly in the trenches, and then identifying, okay, this is a great team, and I just stumbled upon. I didn't even know this should exist, but it absolutely should, and I'm gonna bet here. Like, are you going from a thesis or more so kind of network driven?
So I'd say both, but I don't want it to be a cop-out answer. I'm saying it's both. So let me explain. Very much thesis-driven, where have a particular view, and it's like, these are the things that I think are going to be drivers of markets. I think more capital is moving on-chain. There's going to be a need for more liquidity and more financial tooling around those assets that live on-chain. You're going to see growth in things like stablecoins, yield products. You're going to see growth in kind of adoption of scalable execution environments. You're going to see increasing kind of adoption of consumer products driven by abstracting away and kind of bringing down the crypto element of a protocol so that it's more consumer friendly and user friendly. We're going to see things like resource networks come on chain and take advantage of this open marketplace of suppliers and consumers of different resources, leveraging novel tokenomics. But then when you take those ideas, I'm constantly refining them based on what I'm seeing is working, what's not working, and having lots of conversations, because I very much believe in strongly held beliefs. Strong beliefs loosely held. So the idea that you can change your priors when you see something working and something not working, but you're not just hopping from idea to idea. So, for example, the very first investment that Relayer made on the venture side was in EtherFi in their Series A. So I had been a big proponent, during my time at CoinFund, on liquid staking tokens and had made investments there. And at that time, LRTs were just coming along, and knew that I wanted to make an investment there because LRTs very much were the logical next step of LSTs and being able to generate more yield and opportunities there. And then when I spoke with EtherFi, it was that kind of light bulb moment for me in terms of, one, probably a top 5 team that I've ever met in terms of their quality of execution and professionalism, for just the level at which they execute. They get stuff done, they ship on time, they have a roadmap that they stick to, and they have a really interesting vision around how you take products and build products around them to increase user stickiness and revenue value capture. So, what I understood from what they were building is like they were starting with LRTs, but that was to then take those assets and putting them in yield products, to build, credit card products around that, to really build like a crypto neobank. And it also didn't hurt that during the time that I first started chatting with them, they had 90 million of TVL, and by the end of the time that they were raising the round, they had 1 billion of TVL. So it was just like massive growth. But that was something where I came in knowing that this was a thesis that I had, and this was a vertical that I wanted to invest in. but then, that's fine tuned based on, what I'm seeing that they're doing that's working really well, as well as just the team itself, which at the venture stage, that's the most important thing because it's not always going to work on the first try. And you're going to have to make a lot of either large or small pivots and tweaks. Um, so, that's the ultimate driver of can you reach that sort of escape velocity? Um, and Yeah, so I guess kind of went off on a little bit of a tangent there, but it's a little bit of both in terms of how I try to identify investments. And the nice thing, having been around crypto for such a long time, is I have a great network of other investors that I chat with, and we share ideas, and kind of refer each other to different early stage teams that we're chatting with. But also, I get a lot of inbound from founders that see some of the things that I regularly write about, and think maybe it'll be a fit. And I also live on Twitter, so I'm just constantly reading new things and probably send more cold DMs than I receive. So that's a big part about it too.
Very cool. All right. So when you so it sounds kind of like there's obviously like a multi-step process here for evaluating whether or not you're going to make an investment into a early stage startup. It's like you have some initial ideation of some some thesis forms of, hey, this should exist, or you happen to find them. But let's just let's just pretend there's a thesis here, and you find them. You talk to the team, make sure that they're actually executing. So it's like the pace of iteration is really important. Like you need to see that they're constantly evolving the product and moving the ball down the field there. And then traction, I assume, plays a massive role, right? Or maybe it doesn't. Maybe you're like, hey, listen, they are making lots of progress here, but the traction is not too great right now because maybe their BD efforts are not super hot. Or so do you have a checklist that you go through, or like do you have a rough framework of things that you're like, okay, I need to see these 4 things that they're doing, whether it be like they're in the right thesis, they're executing quickly, and their BD is ramping up, or like what is that?
Yeah, so I definitely have a list of items that I go through. Um, they need to be building for a large market where there's a really big opportunity. Even if you have a great idea, if it's a small market that it's hard to achieve a large outcome, they need to be very, very product oriented, because at the end of the day, every company has a product. There's some consumer of that product. If you're an L1, it's applications that are building and consuming block space. If you're a perp it's a trader. If it's a borrow lend, you have borrowers and lenders, and token holders, which is often the kind of ignored third stakeholder. But you need to have a really good product sense, and what I like to see is that they move quickly to build, but also iterate quickly based on feedback that they receive. So you need to have a team that either has demonstrated success in that they've been able to execute in the past, or I can at least see some evidence of that in what they've been building so far. Because it's only really in the heights of a bull market that you'll get a deck and people are raising on just that alone and they haven't built anything. By the time that someone's doing a seed round, there's some evidence of what they've built, and even if the product isn't live, so you can get a sense for that. The traction side is really dependent on kind of how early or late stage it is. If it's early and the product's not live, you kind of have to anchor to some of those other things. If it is live, you definitely want to anchor to how well it's resonating. But if it's not resonating and there's not a ton of traction, there needs to be good answers as to why. And you want to see a strong understanding from the team that they're either trying to get more feedback on what's not working, or they've identified what's not working, and then they're kind of rejiggering around that. So that's one thing, for example, with Maple Finance, that I think, and I didn't invest in them in the venture stage, invested in the liquid stage. But that's something that I think they did incredibly well, where if you look back to the last cycle, they were focused on under collateralized lending. That didn't work because there were a lot of counterparties that ended up blowing up. Rebuilt the model around collateralized lending, focused on bridging the gap between centralized borrowers and at that time, KYC permissioned lenders focusing on institutions. And what they realized was, the KYC and the white glove service was really most important on the borrower side, but they were able to really unlock an enormous amount of capital by having permissionless lending and giving users the ability to essentially determine the extent of their yields. And what I mean by that is if you can tokenize the asset that is being lent out and you get a receipt asset, now you can loop it in a borrow lend, you can strip it and have PTYT tokens on Pendle. So it's kind of like that was the key unlock that they realized: make the lending side completely open, permissionless, tokenize the asset, and then, it's since grown the Syrup USDC to over $3 billion of TVL and about $1 billion of loans issued. So a team that is constantly iterating and looking for that thing that's going to drive loyalty and strong engagement among their users. And then also, because this is clearly an important part within crypto, is founders that are looking to drive value to token holders that are aligned there. I think it's always really difficult if you have like some equity-based monetization, some token-based monetization. I think everyone needs to understand how the value flows. And I think if you do it pretty much primarily to token holders, then you have this really nice alignment with a third stakeholder and founders that also understand what sort of tokenomics work, what don't work. I actually work pretty closely with founders, and that's one of the things that I like to lean in on the tokenomics side. And I think I'm forgetting something. And then I guess just the last bit, but this ties in with team, is a team that's in it for the long haul, because for the long haul, because if you think about like how long these sorts of things take to build, it's typically many years. And TGE is like the second inning, right? It means nothing. It's just the liquidity event. It's not like the equivalent of an IPO for a traditional startup. So really want to back founders that are thinking on a 5-10+ year time horizon.
That's awesome. Okay, so the token aspect is so interesting because you could have a great team that's working hard on a product, that's iterating, constantly updating. They have great BD. They're talking to everybody, but maybe their token design is not set up correctly. So it's kind of like maybe they're getting usage, but it's just not accruing, or who knows what. How do you approach token design? Like, are you willing to work with a team that you think is stellar, but their token design is all messed up, and you're like, you know what, I'm going to put in the days and weeks and months in order to help them launch 2.0 version of other token, in order to set it up correctly. So as you mentioned, like, value does accrue to token holders.
Yeah, so absolutely. It's of course on the venture side a lot easier because usually the token isn't released. And also, I find that founders are pretty open to feedback. I think sometimes even to a fault. One of like my strongest beliefs, and I know it goes a little counter to what I'm saying around the like advisory side and working with teams on tokens, is ultimately I'm investing in a team because I think they're best suited to do what they're intending to do. So while they should take their investors and other stakeholders' feedback, they're the ones that ultimately should be making these decisions. And you don't want to be too swayed by people that may not necessarily be the subject matter expert in exactly what they're doing. And often investors don't always give good advice. So that's a really important part of being a founder, knowing which advice to take and which advice to say, like, what, thanks, but I don't think that's right. But yeah, I definitely look to work closely with them. And then if it's a protocol that's already live, definitely chat with teams pretty regularly. It can often be a little bit more binary because once the token's already live, it becomes less malleable. So there's something that it may just be so much of a disconnect that it's really hard to get there on it being an investment. But then again, for example, there's a lot of protocols that could be solved if they implement like certain staking mechanisms or fee switches or redirecting value to token holders. Like that's, for example, something that Syrup implemented over the last year, where they started using a certain percentage of their revenue for buybacks to 20%, and then since 25%, and that's being distributed to stakers. Marinade Finance is now going to do. It's going live soon, but it passed through governance. 50% of protocol revenue to go to the buybacks, and you see lots of examples like that. So it is a little bit different on the liquid side because it may be a reason why something is investable or not investable. But at the early stage, there's a lot more flexibility.
Yeah, and this is a broad question because the answer is like it depends on what you're building. But if you could encourage, or I guess for this example, force all the companies that you invest in to adopt one token model, whether it be like, hey, I think the best token model is buybacks, or the best token model is you stake and then the stakers get the X% of revenue, or whatever, X% of fees. Like what in your opinion, what is the ideal token model that you would love to see your portfolio companies adopt?
Yeah, so that's a great question. I think a little bit difficult to answer because one, I think it's vertical specific in terms of what type of application use case layer of the protocol stack. Another piece is just how mature they are, and how much revenue are they generating or not. I think one of the clearest, most straight down the line is there should be some amount of buybacks in terms of clear that protocol revenue does accrue to token holders in the form of accumulating an asset. I think just arbitrary buybacks isn't necessarily the best way to go about it because your token could theoretically be very overvalued and you're taking cash to buy a token that in a certain period of time could be going down 80%, right? So you don't necessarily want to have programmatic buybacks that are happening at all times. So I think having flexibility based on the relative valuation and multiples of the asset is important. I think one thing that, like, maybe to answer your question the opposite way, what's one thing that makes sense not to do? It's not like the absolute worst thing in the world because it does reduce supply and return value in one form to token holders is burn tokens. I think buy and burn doesn't make a ton of sense because you're essentially taking revenue that's generated, you're buying up assets, so that is creating buy pressure and reducing supply, but you're essentially burning money. It's a buy and burn. And I think those assets could be used productively in a different way. You can say this is moving to the protocol treasury and it's not intending to be spent. But down the line, if there's a growth initiative that you want to fund, I think it's better to have the capital than not have the capital. So I'm a big believer in buybacks. I'm a big believer in distributing some of those buybacks to stakers. I also don't think necessarily that all of the revenue of a protocol needs to go to token holders because, if you think about buybacks and also income going to stakers, that's a decision that, one, you want to reward your stakeholders, but two, it's a decision that you don't necessarily need all of that money, or if you're doing it to the 100% extent that you don't need any money to grow the business. And to the extent that you can create leverage on the operating business by using capital to hire new devs or spend on infrastructure or like do any other component, I think that's absolutely worth doing. And all of these, nothing in crypto for the most part is at a stage of maturity where there's no more opportunities for growth. And that's part of why I think buy and burn doesn't make sense, because even if you're using protocol revenue to buy, you still have that optionality to invest in the business just with your own token, for example, in the form of incentives or emissions.
In your opinion, what is the ideal, I guess, again, the answer is it depends, but the ideal ratio or a percentage of revenue being used to, buy a token, stake, or whatever, right? Is like 50% of product or protocols revenue? Is it 20%? Is it 100%? Like what is the ideal? 'Cause I know like in crypto land, people are like, oh, they're doing 95% of the revenue is being used to buy back token. That's amazing. It's like, oh, they're only doing 5%, or like they're doing none. It's like, so there is but yeah, from your standpoint, like these companies do need money. I guess they could like buy their token and stake it and get some money that way. But what is the ideal balance there between making token holders happy and then also supporting the company operations?
Yeah, so that's a great question. I think one piece of nuance there is what are the operating expenses, if any, from that revenue? So is it pure protocol revenue with no costs related to it, and then you're thinking out of the pure 100%? Or are you thinking of like revenue, but it's really a smaller bucket or piece of that pie that can actually even be bought back? So, using just Maple as another time as an example, they're earning 20 million of ARR, but they also have employees and salaries and, other related costs. So, you have to think about it from that smaller bucket. So, right now it's 25%, but it's a higher percentage of what you can say their net income than the 25%. Whereas, for example, Aerodrome, right now they have $200 million in revenue. There's no associated cost with that revenue. So they can distribute all of that to stakers, which is what they're doing. And I mean, it's pretty wild right now. The yields are about 40% to staking Arrow. So I think that's one important piece. And then the other important piece is if you always want to see it moving towards more buybacks, in my opinion, right? And I think it's just a function of like, what's the opportunity to spend to grow the protocol? And over time, you also expect that the margins of the business are going to improve. So both like the cost of goods, so of the gross margins of the total revenue, and then also taking out operational expenditures. So you want to see that, for example, go from 10 to 20 to 30 to 40 over time. So I don't think really it matters where it starts as long as it's increasing. But the one thing that is non-negotiable is that the revenue needs to go to a treasury that's controlled by the protocol, that at one point or another can be used, and that can be used to go to token holders, or at least accrues to token holders. Because what you don't want necessarily is that there's some outside business that's earning all of the revenue, and then you have 10 or 20% that buybacks, and maybe that increases over time, but then there's this separate bucket. It needs to all be part of the same bucket. And maybe you're not spending all of the revenue that you could be for buybacks, and you could do even retroactive buybacks. That's one thing that, for example, Metaplex did. But right now they're using half of the prior month's revenue to do token buybacks. But for the period, I think it was maybe 6 or 8 months, once they started the buybacks, they were doing a certain amount that was from what had already accrued in the treasury, as kind of like a catch-up of sorts, where it's like, we're doing 50% of the prior month's revenue plus a certain percentage of the amount of capital that we've accrued historically. So that's something you can see as well, but you want it going to the right place where eventually it can be part of that pie. Does that make sense?
So how do you imagine that tokens are going to evolve going forward? Like, do you think that like crypto markets are going to look a lot more like securities and just like equity markets, where hey, they have this much cash flow and they're all going to end up at some sort of standard where it's, I don't know, let's pretend, oh, they do 50% buyback and they send stakers, just for example. Like, do you imagine that the token markets are headed for standardization and are going to look a lot more like securities than how we imagine crypto is, today?
So I do think they evolved to be much more focused on generating cash flows and also distributing cash flows. I think it's going to be a lot more governance oriented than we see in equity markets. But also, I don't think a direct democracy works if you look at DAOs and everyone votes on everything. It just doesn't work. Like we're going to see, the equivalent of board of directors and councils that are the ones that make the decisions, and voting more around electing the right representatives to fill those roles. The market structure bills that we should be getting this year should be really helpful in defining what a token can and can't do, so that you don't have to be concerned, is this a security or is this not a security? But really create the right sort of new framework that's evolved and adapted to this new type of asset, and new form of asset. And another thing is, I don't know that it necessarily means that we're going to have more tokens distributed to stakers. I think that's one thing that we've seen historically, because operating expenses of protocols have been typically really low. So there hasn't been a ton of need to reinvest. But if you look at most stocks, a stock with a really big dividend has 5% dividend. And, if people think the staking yield is 5% for a token, that's considered really low. And, the majority of growth tech companies don't have dividends, so don't distribute anything. But the idea is, it's still, you have this alignment that the capital is going towards future growth. So I think as long as that's there, then I think the token design will work long term. But absolutely, we're shifting more and more towards the protocol, the application. It needs to generate value in a clear and not abstract, not 10 years from now, but like a defined way. And I think that was the really big driver if you look at Ethereum in 2021. And then also some of the Ethereum bears in later years was how much revenue was generating, and how much how deflationary Ethereum had become, and then how we saw the decline in revenue. And the same thing for people being really bullish on Solana or Hyperliquid or Athena, EtherFi, Maple, Arrow. You can kind of name a lot of the protocols that people are excited today. But with any industry, we're very much kind of in the middle of this evolution from ideas towards tangible traction.
Are there any tokens out there that are kind of, in your opinion, like operating best practices with revenue, kind of revenue being sent back to holders and whatnot in some form or capacity, and they're just like that? This token is just not getting any love from the broader market? Or would you argue that kind of within this world of revenue generating products within crypto, the known universe is pretty well understood and like appreciated by investors?
So it's an interesting question, because I think it's decently well understood by investors. However, you have these periods, but there's one piece is, there's a limited set of capital that's focused on fundamental investing in crypto today. And that's, certain, individual investors or whales or funds. But you don't typically see traditional asset allocators, when they're making investments in crypto, going for those sorts of assets. They're going for high market cap, high liquidity, dominant players, primarily the majors. So let's say Bitcoin, ETH, and Sol, right? But I don't think we have those fundamental traditional investors who've started allocating to those sorts of asset in crypto. I think that'll happen. And then the other piece is, you have a lot of competition where people think there could be more beta or higher kind of return potential in a meme coin, or an L1 that just came out that's a shiny object, or like all these different segments of the market that have it's like the joke from Silicon Valley. It's like, it's better to earn zero revenue than like $100 of revenue, or like the Russ Hanneman quote, because then you don't have there is no multiple. There's nothing for people to value against. So I think that's also a headwind for cash producing protocols in crypto, where there's a lot of shinier objects around, and for that reason, there's periods where a lot of these protocols with a lot of traction, in my mind, are quite undervalued. And then there's every once in a while, there's the revenue meta, as people like to describe it. This is usually during downturns in the market, or just post downturns, where people look to move to less risky and safer assets. And these are usually the ones that are producing revenue, because there's a more fundamental way to value them and think about what a floor valuation looks like. And, that pendulum swings both ways. But overall, right now, I think these sorts of assets in crypto, these fundamental cash flow producing assets, are quite undervalued. Where you look at Maple today and it's valued at 25x revenue, but they've grown revenue 10x in the last quarter, and TVL 10x, or Aerodrome has gone up by multiples, and in terms of its revenue, but it's trading at 6x. Or you have Hyperliquid trading in the teens, or a ton of different examples of things like that. And the PE multiple in the S&P 500 is in the 20s. So they're valued, even though they're much faster growing, they're valued at a fraction of traditional equities. And I think a big part of that is questions around how durable is that revenue and how durable is that income, and if it's not sticky and there's not a lot of moats, that's not something people are willing to pay for. But also, I think it's about the amount of capital that's currently being allocated to that vertical and segment of the market.
Yeah. Okay. So speaking of, you're mentioning PE ratios and kind of the TradFi connection here. We're seeing TradFi finally make major inroads this past year into crypto, primarily through DATs, which I would argue that they don't really have too much to do with the fundamentals you're talking about, like cash flow and whatnot. It's more like, hey, we are now buying a bunch of Solana or whatever. How do you feel about that? Are you excited that these are existing and you're happy because it's going to bring more capital to crypto, or I don't know, do you feel a certain type of way about DATs in general? And I just want to hear your general take on this movement of TradFi is finally entering, but not in a way that I expected.
Yeah, so definitely didn't expect the extent to which DATs have been blowing up. MicroStrategy is something that most crypto people have been skeptical of for a long time, and has been persistent and durable. And once people realized that, started to copy that model. I think it's something that worked really well for MicroStrategy because you have Michael Saylor as this enormous proponent of Bitcoin. He's not selling, is never selling, and they've been able to run this accretive strategy where the value of the stock is trading above the net asset value of the balance sheet holdings, and they can essentially put $1 in a box and sell it for $1.50 and use that $1.50 to put $1.50 in the box and then sell the dollar for $1.50, or on and on. So we've seen a lot of instances of this recently. I think way too many vehicles have been launched that now there's very little interest in the 30th Ethereum or Bitcoin vehicle. And we're seeing for a lot of other assets that in the earlier stages, some more Solana vehicles coming to market, some DeFi ones for example Athena, and some Hyperliquid, and some others. Even saw, for example, a Litecoin one. I think short term, it's probably a good thing for crypto assets generally, just because it means there's more price insensitive buyers who are just trying to acquire as much of the asset as they can. So that's on the DAT side, or the token holder side. If you're an initial investor in a DAT, there's been somewhat limited downside historically because we haven't seen a ton of these trade below their net asset value, and they can raise the floor value of what they hold over time if they're able to trade at that premium to NAV early on. But that's becoming less and less, especially over the last couple of weeks. I think it's incredibly risky for anyone that's buying on the open market, where you're buying 3 or 4 times the value of the holdings just because you think they're going to be able to increase the amount of assets per share over a long time horizon. So I think that's by far the riskiest. Long term, there's a question on what do these vehicles do if their stock trades below the net asset value of their holdings? Do they just stop issuing new stock and not dilute stockholders by selling below that? Do they sell assets and buy back their own stock to bring it back up to that, 1x MNAV level? But then that could create this loop where more and more the assets that were, the crypto assets that were bought that caused all of the movement up, you could see that unwind as people sell the crypto assets to then, bolster the stock price. Not a ton of debt has been issued other than MicroStrategy. So I don't think there's, at least at this point, a big risk of needing to sell down crypto to pay back the debt. Although I'm sure that's going to be an issue down the line. I think most of this debt's maturing in 2027, 2028. So that will be potentially a consideration then, but likely increasingly a consideration as some of these newer vehicles start to issue debt. So it's something that I'm watching closely. It's not a segment of the market that I'm super bullish on, other than in like specific instances where I think, I think there's actually interesting opportunities if you have a vehicle that can acquire crypto, but the crypto and the underlying business produce cash flows, and then you can create an operating business around it, almost like a Berkshire Hathaway, where Berkshire Hathaway had the insurance businesses and Geico and others that had cash flows that allowed them to invest in other things. I think that actually could be potentially really interesting. But with the Bitcoin and ETH and Sol debt vehicles, that hasn't really been the priority of what we've seen so far. But where I think Relayer has the most edge is looking at these early stage teams, working with those teams, and trying to find underappreciated opportunities or products in the market.
What are you thinking about this trend towards? I feel like every fintech, and is starting with fintechs. I'm sure it's going to evolve in the future to like, banks and other institutions. But I feel like every fintech is now working on their own stable or their own stable infra, or I think PayPal is working on stable coin. Stripe and Paradigm just are now say they're building out. I think it's called Arc. I mean, don't quote that, but like one concern it's funny. It's a concern I have, but only just because of like my own friends and whatnot. But I'm like, man, I would hate to see my friends and contacts and people I've worked with for years, like, finally when the institutions are coming, it's like they actually don't, their protocols, their products, their companies are not benefiting in the way that I hoped they would, because maybe they're not ready for prime time, or maybe Stripe or whatever needs full control over that flow. But I'm like, man, are we just going to be in a situation where like we built all this tech and then these big institutions and corporates come in, cherry pick like the best parts and like piece together something that's even like superior? And, everyone that we know and are friends with are like, going to like, not everyone, but a huge portion are going to be like, man, we are left out to dry here. Is that something you think about at all?
Yeah, so it's an interesting question. I think a lot of this is the desire for reducing dependencies, in terms of like protocol level and managing the stack, but also having control over specific elements of the smart contract environment or sequencing and ordering, and for example how custody or account abstraction is managed. But at the end of the day, the blockchain has, in my mind, no purpose if it's completely in its isolated own world. Otherwise, you just may as well have a centralized server. And we went through this whole thing in prior cycles with permissioned environments and permissioned blockchains, or private blockchains, with which a lot of banks were exploring, which at the end of the day never found any adoption because they lived in their own silos and they didn't benefit from composability, which is really the key unlock with DeFi. So even if we see Stripe and Circle, find success on their own L1s and build there, I think that's just really positive for the rest of crypto, because you're going to see these assets flow onto Solana, onto Base, onto Ethereum, into different environments, and be used in different protocols. And maybe, for example, the asset will be natively issued on Stripe's chain, or there'll be like specific functionality that's there. But if it's in this closed off world, I don't really think there's any sort of benefit to it, and I don't think it'll be widely used. So I see it as a way that these companies are trying to exert like a little bit more control, and make sure that they're not held up. Because like, I mean, we'll often see applications move from one ecosystem to another because, you know, the execution environment that they were building on was just developing too slowly. And I think that's something that they're trying to manage and avoid, and potentially some like KYC elements. But I think this is all massively going to, drive a lot more adoption in the open permission environments that we've been excited about for years.
All right.
Or sorry, open permissionless environments, not permissions.
Yeah. All right. One more before the closing questions. What, in your opinion, what's the most significant opportunity in crypto that people are not really paying attention to? And it could be something that's very obvious and you think it's like still under hyped.
DeFi. It's kind of it's something that people are really, really excited about, obviously. But I think there's, for people that have been around the industry so long, these numbers that we're seeing today in terms of where TVL is and revenue levels and market caps, they seem high because they're high historically. But then you realize, like, all right, the total value of crypto is, around 4 trillion. That's the same value as Nvidia, one stock, right? People think like, all right, most layer one blockchains have peaked around 10 billion. 10 billion is a really high number, hard to surpass. A $10 billion equity is like something probably a lot of people just like might not have heard of that company, right? You see, a protocol that has a couple $2 billion of TVL. Like, all of these numbers seem large, but they're still really, really small in the grand scheme of things. And, what we're seeing is, and we're seeing this with Stripe, with Circle, with Base as they look to, or Coinbase as they look to connect all of their retail users on chain, is the on-ramp and the funnel is now directly connecting on chain. And the amount of users that are coming on chain is about to like 10x or 100x, which means these numbers are going to be a lot bigger. Like, if you see, a DEX that's doing $1 billion of volume a day, and that's historically been really, really large numbers, we're going to see $20 billion a day. We're going to see much, much bigger numbers. So I think people have gotten a little too, anchored to where we've been historically and where we are and how big the opportunity is. And like, I think Bitcoin and Nvidia are actually great examples of this, where they've both recently been trending near all-time highs, right? And on a day where Nvidia is up 3-4% to a new all-time high, people are like, okay, this is great, but they're not going crazy. But if you say had Bitcoin jump from 122 to 126, it on a given day, right, and it breaks a new all-time high and it's up $4,000, it feels like this earth-shattering moment for everyone that's been around for a long time. But at the end of the day, it's just a 4% move. So, over time, I think, and this changes as you get new entrants who are less tethered and anchors to the small, very, very, very small numbers that we experienced when, people have been a long time got into crypto. But yeah, I think just the size of capital moving on chain and what that can do for the leading protocols and execution environments is just a lot bigger than people are realizing.
It's a very good point that we have existed in our own little universe for so long, and the numbers that we all talk about are just absolutely nothing comparative to TradFi. Like you mentioned Nvidia is Bitcoin, right? Like the same market cap, right? Which is bonkers if you think about it. So no, it still feels. I know we always say like, oh, we're still early if we're on the ground level, but it still feels like it. It's which is pretty.
Yeah, I mean, it's actually really interesting because, I don't think we're super, super early. Like, people recognize what the opportunity is, but it's probably, in terms of the risk reward, one of the times where it's been most de-risked and the biggest opportunity since the early days of crypto, because now, like, it is absolutely definitive that crypto is here to stay, and we're seeing massive, massive adoption in a way that we've never seen before with these ETFs and DATs and, adoption of major technology companies. So yeah, it's kind of interesting. It's like we're early for the growth stage. It's kind of the way I think about it.
Totally. All right, Austin, this has been incredible. It is time for the rapid fire closing questions.
Okay, let's do it.
All right. Is the 4-year cycle dead?
Yes and no. I think Bitcoin will continue to have a 4-year cycle to some extent just because of the halving cycle. I think overall, though, we're not going to see these, every 4-year 400% increases and then 90% pullbacks. I think the volatility on the large cap major assets is going to shrink meaningfully. I don't know that we'll ever see Bitcoin go down 90% from peak to trough anymore. Maybe it goes down 50 or 60%, but that is narrowing. But I do think we're also starting to see these more mini cycles where particular verticals, whether it's AI in Q4 of last year, or individual ecosystems, or DePIN or this and that, can have periods of rapid speculation and euphoria and then pull back a lot and then kind of go up again. So I think it's more Bitcoin 4-year cycles, these mini cycles in other assets when narratives and attentions move around. But I think we're just generally trending more so like traditional markets where things are volatile but moving up over time.
All right, you have to tell your portfolio companies to build on one chain only for the next 3 years. So they can't once they choose it, they have to choose it. Which chain would you suggest?
All right, so I'm gonna be annoying, and I'm gonna give you two chains for different reasons. I'm a huge fan of Solana, and I think it has the highest level of scale in kind of scale with composability. But then I also think there's an incredible benefit to being deployed on Base in the distribution that you get with Coinbase. That's pretty unparalleled. So I'll say 2 execution environments, and it's Solana and Base.
Like it. All right. What is the best investment advice you've ever received?
Don't trade too much.
I like that.
Yeah, it's another kind of way of phrasing it is like your money is a bar of soap. The more you handle it, the less of it you have.
I think that unless you're doing HFT, I think every stat shows that if you're over trading, like you tend to just mathematically, you just tend to lose more. So I think that makes total sense. All right. If you go back in time and give yourself one piece of advice before starting Relayer, what would that piece of advice be?
I guess skate to where the puck is going. It's always easy to be caught up in the moment and busy with a million different things, and you're trying to manage resources according to where you are today, and you're trying to think about like, all right, well, what's successful in the market today when you're thinking about investments. But 3 months from now, 6 months from now, 1 year, 2 years, 5 years is inevitably going to look different than what today looks like. So make sure, whether it's like building Relayer and resource allocation, or when you have a thesis for an investment, or whatever it is, that you're skating towards something, not skating to where things are today.
10 years from now, where are you? Where's Austin and where's Relayer?
So Austin is running Relayer. In 10 years from now, Relayer is going to be hopefully a lot bigger with a much bigger team, and a lot of folks that I bring on that are smarter than me, because you always want to bring on people that challenge your opinions and and are of course really competent, really intelligent, and bring things to the table that you don't. And whereas Relayer is doing what I'm doing today, but just at a much bigger scale.
Austin, this has been incredible. Where can people learn more about yourself and Relayer?
Twitter. I share a lot of my thoughts on Twitter. It's just at Austin Barak. Share theses on what I'm looking at in markets. Obviously, nothing that I said today or on Twitter is financial advice, but that's probably the best place to find me. And if you want to brainstorm or share ideas, or just feel like you want to reach out, send me a DM. I do my best to stay on top of that and respond to all of those. So always happy to chat.
Amazing. Thank you, sir.
Thank you, Andrew. Great chatting today.